And how do these factors, such as preferred creditor status or jurisdictional challenges, impact national DFI's ability to secure coverage?
The market has had a long history of working with multilateral insurance agencies or export credit agencies.
So insurance, I think, has come out of the shadows. It's become a much more relevant product to many of the.
I'm Brian Canup, Assistant Editor at Trade Finance Global.
Hi, I'm Harry McIndoe. I'm a Director at BPL.
Hi, I'm Sean Austin. I'm a Director at BPL.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG.
Welcome to Trade Finance Talks. My name is Brian Canup, Assistant Editor at Trade Finance Global. Credit and political risk insurance, or CPRI, has become increasingly important in the current global environment. CPRI used to be a topic that was generally only known to those within the international trade industry, but is becoming increasingly more of a household name. This is for many reasons, which we will cover later in this podcast. And I'm happy to introduce two experts, Harry McIndoe and Sean Austin, directors at BPL, who will help break down the CPRI market and how they're utilized by players such as DFIs and MDBs. Harry, Sean, welcome to Trade Finance Talks.
Thank you very much for having us.
Thank you.
Great. So can we start with a brief introduction? Who are you and what are your roles?
I'm Harry. I'm a Director at BPL. I've been at BPL 16 years now. I've had the pleasure of working across most of the different parts of the business with all of our different client segments. Spent the best part of 10 years in Asia. And now my role is really helping coordinate our product and business development activities, including when it comes to DFIs.
I'm Sean. I joined BPL nearly a decade ago now. And much like Harry, I've had the pleasure of working across all of the client segments. So regulated FIs, banks, corporates, traders, and DFIs as well. I currently manage a team of 5 brokers working across regulated FIs, corporates, and also DFI clients. So have some recent experience of working on clients such as these.
Great, so let's dive straight into this. Kind of start with a bit more of an educational piece for some of our viewers. Harry, I'll start with you here. Could you define CPRI and explain how DFIs are leveraging this tool to navigate the current geopolitical and geoeconomic landscape?
We're in the part of the insurance market which provides, on the one hand, non-payment insurance, and on the other hand, political risk insurance to banks, DFIs, commodity traders, exporters, investors. Essentially, it's a silent risk participation from an A-rated or AA-rated insurer that sits behind the policyholder, protecting them from losses on their funded or unfunded exposures. Most of the activity that we see is on the non-payment insurance side, and the cover there supports or covers non-payment for any reason. It's a comprehensive product. It can be viewed essentially as a guarantee. The terms and conditions are quite slimline, and any conditions that remain are really manageable within the insured control. It's really good at helping clients manage obligor and sector risk limits. For regulated FIs, the capital relief angle has been a big driver over the last 10, 15 years. For DFIs, crucially, it really helps facilitate greater origination capacity and allows them to leverage their balance sheets. Another growth area we've been looking at recently is on the SRT side, significant risk transfer, and introducing a tranched approach to ensuring risk portfolios. So that's something that DFIs have become increasingly interested in recently. When we look at the insurers and their appetite and the types of transactions that they can underwrite, tenors have stretched massively in the last 10 years, which really helps match what the DFIs are doing in the longer tenor space, as has appetite really widened, and the asset classes that are now coverable has expanded immeasurably in the last 5-10 years. When it comes to DFI's interest in CPRI, it's not really new. BPL's work with DFIs goes back to the 1990s. We were appointed by the World Bank way back in, I think, the 90s as a special advisor when they were to help set up ATI, which is now a TD, as well as some 2 Eastern European ECAs. And interest in our markets really picked up in the last couple of years. As I said, starting with ECAs going back a while and a handful of multilateral development banks. In the earlier years, insurance use was somewhat understated. It now clearly is very prominent, and it's no longer hiding in the shadows. Some of the insurers that we work with, DFI business represents about up to a third of their portfolio. So it really is a core part of what people are focusing on. And when it comes to insurance, perception of insurance in the DFI's eyes, I think there's a heightened awareness generally in the market of the need to mobilize more capital to help meet the UN SDGs. And also the G20 Capital Adequacy Framework report really underscored the importance of insurance insurance when it comes to enhancing lending capacity and enabling DFIs to leverage their balance sheets. So insurance, I think, has come out of the shadows. It's become a much more relevant product to many of the DFIs.
Thank you so much for that. Sean, Harry just touched on how DFIs have been using CPRI for quite a while. He touched on a little bit of evolution, but I'd love to hear a bit more from you about how this has evolved over the years and what untapped opportunities you see. And let's take a particular view and look at Africa for this.
Obviously, as Harry has already said, the market has had a long history of working with multilateral insurance agencies or export credit agencies in providing reinsurance capacity to these entities. In recent years, that has broadened to cover non-payment cover to bilateral and multilateral development banks. This has really been a means of managing counterparty, country or sector exposure, but also importantly, to mobilize private sector capital. I read a recent report published by the OECD, which is saying that the DFIs and MDBs are only currently mobilizing about $50 billion of private capital on an annual basis. And that's a small fraction of the annual financing gap for achieving the UN Sustainable Development Goals. I think we can kind of break down the use of CPRI by DFIs and MDBs into three broad categories. And so the first one would be single situation non-payment cover, and that would be providing non-payment as a result of any reason which Harry has said, and that can be on a single transaction basis. That has also broadened out and into more portfolio-based covers. I think the IFC have extensively published information about their managed co-lending platforms. And I think that's now in the third iteration. And that's brought in, I think, $3.5 billion of private insurance capacity to their FI books. And there's also been securitization-like programs which have been put in place where insurers take a mezzanine layer on a reference portfolio of sovereign exposures. And obviously, these are all great examples of mobilizing private capital, but we think there's still much more room for growth. You asked about Africa. I think it's clearly an important continent. In terms of the market itself, its roots are in supporting emerging market risk, and be that for the political perils which Harry mentioned earlier, but also for non-payment covers. So the market has both a lot of experience and know-how on the continent. I think in recent years, the market has tried to diversify its portfolios and move more into developed markets, but that doesn't mean that they're sort of turning their backs on African risk. If you look at BPL's portfolio, which has grown to about $83 billion currently, roughly 12% of that is in Africa. And if you think about how BPL's market share stands, I mean, we estimate that our market share is roughly between 15 and 20%. And so the market is carrying $50 billion and upwards of exposure to the African continent. So there's clearly a lot of risk-taking appetite in the market. What opportunities do we see? Well, I think that's an interesting question. In recent years, there's been a lot of development in developed markets to covering digital or climate transition projects. And these are clearly going to come to the African continent at some point. I think on the basis of covering a commercial bank, it may be quite tricky. But if you have the existence of a DFI or an MDB in the equation, I think that's really going to bring some insurance capacity to those sectors.
Great. That was a really insightful answer. Thank you very much for that. And now that we covered kind of the basis here and got a bit of that educational background, I'm going to go back over to you. Can you talk us through some of the current conditions that you're seeing in the CPRI market? And if you have any case studies or stats, that would be really useful for some of our listeners, especially in terms of country risk, political risk insurance, private insurance claims, kind of in these areas.
When looking at our little bit of the insurance market, I find it quite useful to focus on or to zoom out and look at the wider industry, the property and casualty industry, which is rarely out of the news at the moment. Quite rightly so. It's talking about some very huge numbers there, but it's been in the news, particularly in the last few years, because of a unique series of events or circumstances, namely several years of repeatedly high natural catastrophe losses in excess of $100 billion year in, year out. And that is a trend that seems to be increasing with climate change. Also, inflation has increased the asset values of insured assets, so insurers are having to pay out greater quantums. And what does that result in? That results in prices going up. It results in capital leaving the insurance market, prices going up. I think it's useful then to look at our section of the insurance market, which is a tiny fraction, sub 1% of the wider global insurance market. And you can see a market that really is quite insulated. We don't have natural catastrophes because we're insuring largely credit risk. You don't really have catastrophic risk at all, for that matter. Claims tend to be a lot more sort of high frequency, lower volume. They happen throughout the year rather than have one very good year, one very poor year. You don't have inflation inflating the values of assets. to a fixed sum that you get insured. And pricing has remained remarkably static relative to clients' own risk margins. So the market really is in quite a healthy place and quite a bright spot when compared to the wider market conditions. When you look at our portfolio, Sean's talked a bit about the portfolio size, 83 billion at the last count, which has grown by about 100% since COVID, since 2019, which really reflects a big widening of usage by existing clients of the market, whether they be DFIs or regulated banks and FIs or corporates. And the number of asset classes has grown in the last 5 years. It used to be, I think, 11 different asset classes. We're now writing the best part of 20 asset classes are insurable. In terms of that 83 billion, it's quite useful to maybe use our statistics as a proxy for the wider market. We've got about a 15 to 20% market share, we estimate. So if you look at our statistics and extrapolate them out, you can maybe get a feel for what the wider market is doing. Of that 83%, of that 83 billion portfolio, 70% of that is medium and long-term credit risk, non-payment risks. So sovereign and private non-payment. And that's anything with a tenor above 12 months going up to 23 years. 14% of it is PRI, political risk insurance. And then about 16% is trade credit insurance, so short-term receivables insurance. When it comes to claims, so we're very proud of our claims track record. Not many people tend to talk about claims, which is surprising given that we're selling a product that there's a promise to pay, essentially. We've collected $3.4 billion of claims since our founding in 1983, and we're really proud of that, and I think the market should be too. It really shows that the market has considerable firepower and claims payment ability. Non-payment insurance is the bulk of that $3.4 billion. The success ratio, especially in the last few years, when policy wordings have become a lot more streamlined and more akin to a guarantee, the success ratio has been 100%. And we have the stats to prove that. The wider market has the stats to prove that. So really reassuring. Also, another thing that's come out of the statistics in recent years is that quantums seem to be leveling out at around the $500 million a year mark. If you take out COVID, there was some extraordinary losses thanks to aviation finance. But for the last 3 years at least, for the claim statistics for banks and FIs, big 500 million each year. So I think that points towards at least a certain state of maturity of the market. But also, going back to the catastrophe point, it means that insurers are going to stay in business, basically. So all in all, it's a healthier market without big exits of capacity, which is something that clients really need to rely on. They need to rely on the same capacity providers being their sustainable way.
And I think, Harry, probably quite a useful point to say that BPL has a premium flow of about $700 million per annum. And if you take the $500 million of claims into account and also take into account we're only 15 to 20% of the market, that really underlines Harry's point that insurers are going to be around and have the ability to pay claims.
Another thing that we track at our end is gross loss ratios and net loss ratios. A loss ratio is basically the proportion of claims relative to premium. So a loss ratio of under 100 means that the insurer under 100% means the insurer is profitable. Not, then they're obviously paying more claims than they're taking in premiums. In the last 15 years, our gross loss ratio has come down from about 80% to about 50%. And the net loss ratio, so that's the loss ratio after recoveries, has come down, has actually remained static, interestingly, at about 40%. During that time, you've had a massive widening of appetite. There's been a lot more private credit risk being underwritten by the market. I think what that goes to show is that despite the widening of appetite, diversification of appetite, it hasn't increased overall risk in the insurance market. In fact, the statistics have got better. So it really supports the argument that more diversification, insurers supporting clients into new areas, which is what they've really been doing the last 15 years, is good for results.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Really appreciated all of those different stats you gave us. And I think that helps the listeners really break down the market a bit more, because sometimes if you're not working in it on a day-to-day basis, you don't necessarily get the granular stats like that. So really appreciate them. And you segued pretty well into my next question that I was going to ask you, Sean. Talking about appetite. What is the overall appetite among insurers underwriting CPRI business, and how has that changed over the past couple of years? And in your opinion, what are some of the key drivers to these changes that you may or may not be seeing?
I think it's useful to sort of paint the picture a little bit about and contextualize sort of capacity available in the market. So Harry has kind of alluded to the market has moved to a more mature phase in the last 5 years. So to pull some some stats. If you look at contract frustration business, which is default by any sovereign or state-owned enterprise, according to BPL stats, it was around theoretical max capacity was about 890 million in 2008. That has grown to over $3.5 billion in 2024. And to give you a bit more context, it was actually 3.2 billion in 2019. So clearly there's been rather steep upward curve between 2008 to 2019, and that's been a bit more level, the growth in the last 5. And that obviously shows that the market is now maturing. What I think has changed though is that insurers have been pushing out their tenor capabilities, and many now have dispensation or agreement from their reinsurers to be able to offer multilateral development banks or DFIs tenors longer than they would be able to for a commercial or corporate entity. So that really outlines the insurers are willing to follow their clients, such as MDBs and DFIs, on their sort of developmental journey. I think more generally, there has been a drive to diversify portfolios in the last 5 years. Harry's already alluded to it. The portfolio has grown, over 100% in the last 5 years. BPLs, that is. I think it's a bit of a cliche, but there really has been a flight to quality, both in terms of the quality of the underlying business. So insurers have been trying to move up the credit curve, but also they're placing increasing importance in the clients that they insure. There's an old insurance adage that you underwrite the client as much as you underwrite the underlying risk itself, and that really holds true. And so insurers are definitely placing value in MDBs and DFIs as clients. I also think that insurers are under increasing pressure from their own capital providers to insure projects which help meet their own ESG targets, right? They will be under the similar scrutiny as regulated FIs or DFIs or whichever client segment using the market. The capital providers will be under the same level of scrutiny. And there have definitely been initiatives by insurers. For one example, Allianz Trade launched a green to green initiative, which essentially funnels the premium earned under policies which insure projects which meet certain characteristics. They will use that premium and invest it into bonds which have green characteristics, essentially. And we've also had Tierra, which is an MGA backed by Lloyd's capacity, enter the market, and they focus solely on climate transition projects. So there's clearly more focus on the types of business, developmental, that DFIs and MDBs bring to market. Finally, you asked about drivers in what's pushing insurer appetite. And I think it's a really important point, actually. Insurers will follow what their clients are bringing them. Harry mentioned earlier, the types of asset classes has grown from 11 to 20. And that's been as a result of the demand from their clients asking them to provide cover. If you asked 3, 4, 5 years ago, if an insurer was covering digital infrastructure projects, I'm not sure any of them would have necessarily heard of a fibre to the home project. So they follow their clients. That's a result of the partnerships that have been fostered over a number of years.
I'm going to put you on the spot here and ask you a follow-up question about this. Do you see this growth continuing in the coming years, or do you think maybe there's been a lot of development already in the market and it'll maybe stabilize a bit, or do you see an acceleration, a continuation of this growth?
I think it's definitely going to continue to grow, right? There will be areas of a bank or a DFI or MDB or whichever client segment that are not using the market today. Harry said that essentially we cover credit risk, and there will be types of credit risk exposure within banks that are not covered. So I still think that there's definitely room to grow still.
And I'd also just say to that our market's come this far. BPL have been around 40 years. Our market's been around for slightly more than that. And for most of that time, it's operated in the shadows. So we've got this big basically by being a silent participant in all these transactions. But the last couple of years has seen quite a lot of advocacy work, particularly for the European regulators with the transposition of Basel. So that's raised the profile of it. You've got the G20 talking about the use of insurance by multilateral development banks. I think if we've created a market this big by operating in the shadows, I do think there's definitely a lot of upside now that we're slightly less in the shadows.
We've spoken about MDBs and DFIs, and that's the focus of this podcast. Many of these clients aren't using the product in a meaningful way yet, and that's clearly a potential area for growth within the market. So it's definitely an area that will continue to grow.
Let's keep on talking about the DFIs and MDBs, but we can expand this kind of to a broader picture as well and kind of learn from the past and hopefully apply that to the future. Harry, what lessons can the DFIs and MDBs draw from other sectors that have already successfully used CPRI to increase their headroom capacity? And how do these factors, such as preferred creditor status or jurisdictional challenges impact national DFI's ability to secure coverage?
In many respects, as a client segment, DFIs are really no different to other client segments that the market looks at: commercial banks, commodity traders, exporters, investors. But for the risk profile is obviously different. They're achieving a slightly different mission, a different agenda, etc. How the one thing that unifies all of the successful clients in the market is really the institution's ability to get the insurers familiar with their business, with how they originate transactions, what their credit process is like, how wobbles are handled. The insurers really want to see that it's a partnership approach. They don't want to feel adversely selected against. And those people that are able to bring the insurers in and really see them as a risk participant rather than a risk taker, someone you can shovel off the risk that you don't want to hold on your own balance sheet, the more you can do that, I think the more success you're going to have getting support from the market. And as Sean said, in terms of the diversification of asset classes that are covered, it's a sort of chicken and egg conversation sometimes, but it's thanks to that open book approach that a lot of the bigger users of the product have taken in terms of inviting the insurers in to understand how they operate that has really led, that has spurred on that diversification. You mentioned about preferred creditor status. Obviously, it definitely matters, and it's getting a lot more attention in the market at the moment, particularly in the insurance market, but also wider, with several defaults that happened are sort of still ongoing. I think previously, when it comes to our market, there was maybe an assumption going back 10 years ago that any government involvement in an institution, whether it be a national DFI or an ECA, or maybe in a specialised small niche DFI that might have some arm's length ownership, whatever the extent of that government involvement, I think there was a perception that maybe that would be good enough to get problems sorted out at the creditor table. I think it's probably been proven that you can't view all DFIs the same. Not all of them have the same preferred creditor status. So it's quite an interesting time speaking to insurers and getting their perceptions on the horses that they want to back. It's not to say they won't back somebody who doesn't have preferred creditor status. It just means that the larger, more established MDBs clearly get slightly more support and a warmer reception in the market compared to some of the smaller and more niche ones. But even if you are a smaller and more niche one, it's about inviting the insurers in, getting them to understand how you originate, what makes you tick, essentially. And the more you can do that, the more success you can have. Preferred creditor status is not the be-all and end-all, but the insurers underwrite a very small proportion of their business would be sovereign loans, for example, where the preferred creditor status would come into play. The rest of it would be commercial lending, commercial financing, where obviously there isn't. So I think it's just a question of putting it out there at the outset in terms of expectations, what the institution expects to happen in a default scenario and around the creditor table. And so long as people go into situations with their eyes open, I don't think there shouldn't be any worries, concerns to be had.
Bring it back to the subject I think many people talk about, have seen the ADB study for a long time, but in 2023, the trade finance gap grew to $2.5 trillion. And I kind of want to look at that, but from a bit more of a CPRI angle. Sean, I'm going to end this podcast with a question to you here. What do you think the main challenges and risks are that the DFIs face when using CPRI to address this increasingly growing trade finance gap? And one more future outlook for how DFIs can maybe employ this form of insurance in emerging markets?
I think one of the main risks for DFIs or MDBs who are inexperienced when it comes to using CPRI is them not understanding the market or the product. I think that really underlines the importance of using a broker that understands the market and can guide them through the process. So do they have emerging market experience? Do they have good claims track record? Do they have goodwill with the insurers? Are they able to build relationships with the insurance market on behalf of that particular client? I think, as Harry has said already, MDBs are not really any different to commercial banks. Insurers want to have that partnership with them. So as long as they embrace that partnership approach and transparency with the market, they shouldn't encounter too many issues. I think another challenge to placing business is the risk profile of their transactions. And I think it would be naive of me not to mention this. On the one hand, we've got DFIs and MDBs which have a developmental mandate, whereas CPRI insurers active in the market will have to answer to commercial capital providers. And so there's clearly a disconnect there. That's not to say that bridge can't be overcome, but there is a limit to the amount of credit risk which insurers are willing to take. And we just need to be cognizant of that. You can put in place structures which I think can help to overcome that greater risk sharing from an MDB, or an MDB taking a first loss of a particular transaction to put them insurers further away from the risk. And obviously that's a way of crowding in capital. I think though insurers will and have placed a lot of value in the projects and the expertise which MDBs and DFIs have. So they obviously have a lot of know-how when it comes to the countries and the difficult jurisdictions in which they operate. And I think insurers do place a lot of value in their origination strategy. And ultimately, they do bring diversification to the portfolio, which we've already sort of mentioned. And that can only be a good thing for the insurance market.
Great. Well, I want to thank you guys both, Harry and Sean, for coming on Trade Finance Talks. And hopefully this will continue to bring this industry out of the shadows, and we can shine a light more at CPRI and continue to grow this industry and really help bring capital into more markets that really need that, and maybe eventually get the trade finance gap a little bit lower than it is currently. So thank you both again for being here and sharing your expertise. And thank you all for listening.
Thank you very much.
Thanks, Brian.